We are live. Welcome, everyone. George LaRocque from WorkTech here, and I'm excited to be bringing you some more, breaking news. We had a big announcement just go out this morning, and I'm going to let the source of that announcement, Jason Corsello, share that with you in a moment. We are recording this. We're also live on Talent Product Plays. There's a lag into the Facebook group. So please do post your questions or comments. And if we do end up seeing them, great. But Jason and or I will follow up there with you later if you have anything specific that you'd like to learn. So Jason, welcome. Thanks for doing this with me today.
Yeah, George, thank you. It's great to be with you today.
Yeah, it's always good to see. And these times it's good to see you and have a chat. Let's get at the announcement. People are probably wondering, well, why are they here? So I'll let you make the announcement since it is yours.
Yeah, George, I appreciate it. I know, the WorkTech community and all that you do in cultivating this ecosystem is super important. So I appreciate the opportunity to talk to your audience. I'm excited to announce today the launch of Acadian Ventures Fund 1. And essentially what Acadian Ventures Fund 1 is the culmination of a couple of years of work, fundraising, so we can launch a fund that's specifically designed to invest into future work companies. So that next generation of companies focused on the biggest problems that we're facing today that have probably even been exacerbated over the last 12 months. And so today we're announcing a fund upwards of $20 million where we tend to, or we expect to invest in that next generation of companies. We are focused on pre-seed and seed stage companies. And, this is all predicated on our belief that there's a huge wave. This is actually, the fund was actually started pre-pandemic, but with the belief of there's a huge wave of macro trends, technological trends that are going to change the technologies that we use every day, and more broadly, how we work, where we work, the expectations that we want out of work. So I'm excited to announce the fund today. We've actually been actively investing for a year, a little over a year. We have 11 portfolio companies in the fund today, so we're not necessarily starting fresh, but excited to make the formal announcement this afternoon.
Yeah, that's great. I know that's a lot of work. So congrats on closing that. Or getting to this milestone. I have to say, if anyone isn't following Acadian, they should be. You do some really good work there. Along with the investments, you've got a really cool portfolio. Jason, you've been in this market as long or longer than I have, and you're a trusted source of, so I when I see you focus on a firm, I know there's something to look at, but also with your index where you're tracking across the different stock indexes, the future of work companies. I find your work there really interesting, and just your general observations on the market. There's of course it's a fund and all of that, but there's more to Acadian with your advisors and your partners. I don't know if there's anything to talk, you'd like to share with folks that are listening.
Yeah, no, George, I appreciate you saying that. I'm a data geek at the core, and so I look at lots of data, public data, private data, to try to help influence some of my decisions. And certainly, you've done an amazing job with the data that you produce through the WorkTech group. So, for me, I'm a lifelong learner of this industry. I've been in this industry for almost 20 years now, and I love that every day I wake up and I get to learn something new. But I also feel an obligation that, as I try to tell my kids, leave things better than what when you got them. And so I think there's just a huge opportunity in this market to make everything that we do better, whether it's a technology that we use or, just coming to work every single day. And so that's an important part of kind of the core ethos of the fund. As you mentioned, with any venture fund, or I shouldn't say any, but with most venture funds, you have what's called limited partners. Limited partners are essentially the investors into the fund. And I'm proud that we have what I think are some of the best limited partners not just in investing, but also in our industry. So I was very conscious and intentional when I decided I wanted to launch a fund back in 2019, that I wanted folks that really knew this market and that could be helpful to our portfolio companies. And so our limited partners are CEOs, CTOs, CEMOs from companies like Cornerstone, where I came from, Zoom, Workday, SAP SuccessFactors, HireVue, Bamboo. I've tried to really bring some of the best. It's, it's certainly not just me. And I'm lucky to be supported by many of them that help me every single day. I talked to one of my LPs this morning about an investment that we were looking at. And so, the broader Acadian Ventures is a core group of operators and builders of SaaS companies that we think can help, essentially nurture the next generation of companies.
Yeah, you really stand alone in that. There are plenty of firms who, as you know, have put somebody to focus on this market now. There's a lot of venture coming in. We'll get to that in a minute, but it is really unique to see a team that's steeped in operating in, historically focusing on this space, being in this space. So, kudos to you for that. But let's talk about this fund. When you set out, you could have, especially with all of the buzz around, WorkTech right now, you could have gone almost any direction you wanted, but you chose a seed fund. Why a seed fund?
Yeah, George, it's a good question. I think a couple of reasons. One is, this fund, I like to tell people, this is kind of 15 years in the making, in that, of going to conferences and meeting people and understanding technology products and doing, sitting through lots of demos. But one of the things, when I was at Cornerstone On Demand, I spent 7 years there, and we actually launched a corporate venture fund about a little over 5 years ago. And the one question I'd always get from entrepreneurs are, who are the VCs that really understand this market? WorkTech, HR tech, future of work. Yep. And I can never come up with a singular either person or firm. And that's not to say there aren't great investors out there. There certainly are a lot of great venture investors. But I thought a couple of things. One is, this is a big market, as you track every day. I mean, we'll probably see, totally guessing here, upwards of $6 or $7 billion of venture put into future of work tech companies. And so there's a huge opportunity. I also believe that investing does require some level of specialization. I can't go and invest into an e-commerce or a direct-to-consumer company. That's just not my background. That's not my knowledge. So I think there's a really great opportunity to specialize a fund in this market. And to answer your question, why seed, is a couple of reasons. One is it's the part I enjoy. I enjoy those foundational early stage years, to be helpful and be in the quote unquote trenches with the founders. So it's something personally I enjoy. Secondly is, it's a small fund by the nature of things, right? I mean, today you're seeing $1 billion size funds, multi-stage funds, investors coming from every direction. And so just the size of our fund requires that we get in and try to get in relatively early in companies and help nurture them along their journey. So it's part interest, part of it is just the size of our fund. But I just think also we're at an inflection point of technology where, in the last 20 years, we've seen a couple of those, right? We've seen the move to the cloud, which we, came Workday and Cornerstone and SuccessFactors, and name a number of companies. We're kind of in the middle or the back end of generation 2, with a number of companies that have now become unicorn companies. By my tracking, we probably have upwards of 20 venture-backed unicorn companies. Yep. And now I think we're at the beginning of phase 3, which is all predicated on leveraging of data. We talked about AI and machine learning, which is also a very important part. But I think we're at this next inflection point of that next generation of technology. And so that's really what excites me as well. Yeah.
You're doing such a service for the entrepreneurs and the buyers by nurturing this early stage. But the seed rounds, the early stages continue to be really challenging for entrepreneurs who set out. And there were, a few years ago, there was a bunch of buzz that reflected a trend in VC where a lot of people thought there'd be a lot more of funds that are focused on seed, but it seems to have gone, the other way, or maybe I think there has been an increase and it just can't keep up. But why, you're in an interesting seat, right? I've got my thoughts on why it's difficult, but from your seat, why is that so difficult to raise money at that early stage?
Um, the short answer is at seed, a lot of things are unproven, right? The product's unproven in many cases. The go-to-market is unproven in many cases. So it's challenging. There's just a ton of uncertainty. Raising seed, from my perspective, when I make an investment out of our fund, it's a bit art and it's a bit science, which is, I look at the product, I go deep in product. I look at the go-to-market, I look at the trends in go-to-market, although the fact of the matter is it's still relatively early in that customer adoption cycle. So what I try to gauge more is, I have this like 10 factor thing, which I have creative names and I won't bore you with all of them. But one of it is staying in the game. Do they have the stamina? Does the entrepreneur have the stamina to, as I like to say, to get punched in the face every day and get back up? Because startups are hard. Most startups fail, as we know, and it's tough. And so stamina is a really, really important one for me, and it's hard to assess. Like, is this someone that you want to go on a 10-year journey with? So that's one factor. I also try to understand other factors from the product and tech side. Do they have this ability to iterate very rapidly? On the go-to-market, I have something I call zero to hero, which is kind of a lame term, but it's this idea that, to your point on understanding the market, can you build demand? Because what I find in a lot of cases is entrepreneurs either have a great idea, great product and DNA, but don't know how to go to market, don't know how to sell, don't know how to price and package, don't know how to, all those things that you would put in a go-to-market strategy. And so that's something I try to go pretty deeply in, and understanding, not that it's right or wrong, but just their thoughtfulness around how they've built it and how they're thinking about it. So it's hard in the fact that, I think raising capital at all stages is very hard. Even if you've got, the hockey stick growth, raising capital, whether it's for a fund or whether it's a seed investment or whether it's a series D investment, most people have a hard time fundraising. So it's not the individual, it's not the company. It's, to me, it's all about finding the fit with the VCs. And I think that's an important thing that I try to assess is their fit with us and our fund. And can we help them out? And can we, is this something that we want to be on a 10-year journey with?
Yeah.
So hopefully that answered your question.
There
is a lot of seed. It's just finding that right fit, to me, is really the hard part.
Right. I agree. And we could just talk about this for an hour, but we won't. But it's along with all of that, I think a frustration for entrepreneurs is, they may tick all the boxes, but one of the variables that they can't control, and it's unfortunate sometimes, is timing, right? So, an investor may be at a point where they're looking for something that you're not. And it could be any one of those boxes. It could be your market focus. It could be the profile of the founders. It could be anything, the segment that you're focused on. And then there's, in some cases, you're not the only, in many cases, you're not the only startup in your category being considered. And then you've got a number of other variables that you really don't have much control over. And it's a very subjective process, which because these are private investments that are happening. So it's not it's not as fair as I think some entrepreneurs, coming into it, hey, I ticked all the boxes, and it just guts me when they ask me, look at us, why didn't we get this? Why aren't we where we want to be? And it's the toughest question to answer.
It is, and I get the question all the time: is what is our process? And I obviously appreciate people asking that question, but there's never a simple answer, right? I mean, I've made investment decisions literally in less than 2 days. Some have taken over 8 to 10 months. And part of that is just getting to know the entrepreneurs over a period of time and seeing how they work. So there isn't a pure simple answer. And like you said, on timing, like I'm facing a situation right now where I've got probably a half a dozen deals in the pipeline. That may mean I may meet an interesting company, but I just can't get it through my pipeline of investments. And to your point on timing, it's impossible to predict timing. What I encourage is in any case, start fundraising before you actively fundraise, if that makes any sense. Meaning, try to get to know investors that are your fit. I encourage people all the time, like, don't just spray and pray as you're looking to talk to engage with VCs. Be very, very specific on what you want and who is that list of kind of ideal investors, and what is the easy path to get to those investors. So do more. I read a quote the other day, and I'm going to totally butcher this, but I'll try to say it anyways, which is, someone asked Abraham Lincoln, how long it would take him to I'm already butchering it. Like, if it takes 6 months to cut down a tree, he's going to spend 4 months sharpening the blade. Yeah. And so, the more upfront work that you do to do that diligence, the better outcome I think you'll have in the long run. Yeah.
Yeah. That's great advice. So you talked a little bit about what's happening in VC right now. You gave a projection, which, we're seeing a lot of the same stuff. And it's shocking to me how still I was shocked at the beginning of COVID where, the brakes got tapped a little, but there was really no slowdown on any investment. If anything, it amped up based on the drastic changes and the calculus changing a little bit for investors. And that's just carried right into this year. We're about to finish Q1, and I agree with you. We're at least if we stay up this pace, we'll definitely get to 6 billion this year, if not, 2 to 3 times that. It's incredible. So what do you see as the current state of VC in the market at large?
Yeah. So I think your perspective is very interesting. I was at this time last year, I was in the middle of fundraising. We had a few investments in the mix, and then the world basically shut down overnight. And there was this big question is what's going to happen to the private markets, right? Private equity, venture capital, because typically the model is you want to see someone face to face. You want to look them in the eyes, and even for some private equity firms to make an investment, they had provisions in their documents that said you had to meet someone face to face before you made an investment. Mm-hmm. And so there was all this uncertainty that started in March that flowed through a big chunk of Q2. And most venture firms, we were still early in our journey, but we had the same opinion, which is let's pump the brakes. Let's make sure our companies can survive at least through this year, that they've got enough runway. And then let's reassess. Well, holy cow, after Q2, that assessment happened pretty quick, and everyone was straight back, probably within less than 45 days to start writing checks today. And like you said, I mean, I've been in quote unquote venture now for through corporate venture in our fund, north of 6 years, 7 years, and even more broadly, I've watched the venture market for 15 years, and I've never seen a market this hyper forensic. I don't know what the right description is, but I even look at data. So I'm, your data is by far the best in the industry. But the data I've looked at is we're gonna from Q1 of last year to Q1 of this year. So year over year, we're seeing 3x the amount of investment. So last year, in Q1 it was around. I don't track all the categories that you track, but we were about 730 million invested. Q1 of this year, we're north of 2.3 billion, and we still have another day to go to kind of announce those investments. So there's a lot of activity. This is, there's certainly a lot of activity in WorkTech, future of work, but even more broadly, across the spectrum of venture, it's as frenzied as I've ever seen it.
Yeah, no, and I'm seeing a similar, I always wait until that last day of the month to roll it up, because one or two deals in this market can drastically move the needle, but it's tracking just like those numbers are very close to what I'm tracking as well. But I got this whole thing wrong a year ago. There's like I've never been in a fund. I've never been on the investor side. I've been on the other side and on the operator side. And so, when this started, I thought, okay, there's a muscle memory to, what's going to happen
Right.
now in the financial market, what's going to happen as an operator. But specifically around VC, I thought, okay, things are going to slow down for a little while. Investors are going to get, you go back to the housing crisis, you go back to after the bubble burst, some period of time. And it was about, I would say 45 days is probably pretty accurate. And my jaw just hit the desk. I thought things will slow down. Tracking the VC will get a little easier for a little while. It got hard. It got more intense, and
I don't know how you do it to keep up with the pace, but I had the same opinion, which is deals will start to slow down. The pace will slow down. The valuations would come down a little bit.
Yeah.
And, it's gone the opposite direction where, valuations even at the seed stage are, in some cases 2 times what you saw maybe a year ago. Even at the mid stages and the late stages, you're seeing, companies that are doing 20 to 25 million in ARR being valued at $1 billion these days. And so it is, it's crazy. I mean, I think it's certainly good from a venture and probably more specifically an entrepreneur's perspective. You'd probably never, this is probably one of the best times you'll see to raise capital. Now, I probably said that, 2 years ago and 2 years before that. But there's an excitement around venture, and part of it is the quote unquote asset class itself, right? Where, people that maybe didn't have access to venture funds as from an investor perspective or private equity funds, that's starting to open up a little bit. And so you're seeing kind of new investors come into venture. Even on CNBC yesterday, they've been talking about family offices. Family offices are, essentially, high net individuals that have created family offices that are, been moving into venture as an asset class. So with all the moving parts, to me, it's still a very exciting area because, when you look at valuations of companies, it's just, it's mind-boggling, exciting. It's, a great opportunity for folks to generate, to generate wealth and, to show positive gains in their portfolio versus just being in the public markets.
Yeah, I think, we've talked a little bit earlier. You gave a good overview as to, an investor's calculus, looking at the market, what things that you're considering. And you talked about timelines and timing a little bit. What about for folks in the audience who might not in the community who might not have a handle on this? How does a typical VC, how do they make money? What are the things they care about, with that in mind?
Yeah, I think every firm is a little bit different, and part of that is dependent on the assets under management. But typically, so I'll give you our fund and try to talk about what other funds look like as well. So we are an early stage venture fund, which essentially means a couple of things. It means, typically when you're in early stage, it's a 10-year designed fund. So your plan for the fund is to return some, in our case, 3 to 4 times the capital that you've got in over a 10-year period of time. Yeah. Over that 10 years, you typically will invest into anywhere between 20 to 25. We'll probably invest into 25 companies, of which, the first 4 years, 3 to 4 years are really that active investment period of the fund. So you're investing, in years kind of 1 through 3 or 4, a majority of the fund. You keep some capital in reserve to follow on investments for the companies that are doing well. And then hopefully you return the fund after 10 years. And most venture funds, early stage venture funds, strive for about a 3 times return. That's kind of, the bar that most set. Some, overperform, some underperform, but really the kind of for simplicity's sake, you're trying to 3 times the size of the fund over that 10-year period of time. Now, as a limited partner, you have to wait till the 10 years to get your capital back. If a company gets sold. So we had one acquisition in our portfolio that you covered, which was JobPal. JobPal was acquired by Smart Recruiters, which you did a call with Jerome. And so, as we see acquisitions like that, we return the capital we pay our investors back as that occurs. And so for us, every investment I look at is I think about a couple of things. One is, I expect this thing to be at least a 10-year investment. And our investment decisions is, can this be $1 billion company in the within 10 years, right?
Yep.
I'm not, it's great to see companies that have, successful exits, and, we read about them every single day. But the way and I geek out about what's known in the industry is called portfolio construction. So the portfolio construction of understanding how do you get to that return target, and then kind of rolling back and saying, okay, to get there, here's what I need the exits to look like over the next 10 years of those 25 companies. And, for me, what you typically see, and there's been lots of reports and research around this, is if I have 25 companies in a portfolio, usually it's going to be 2 or 3 that make up the fund, that are the fund returners, the outliers, right? So the companies like Zoom or Slack that go public and have these, crazy, returns. So you're always striving for the IPO. It doesn't happen that often. So it's certainly very rare. But that's how we look at it is, typically you want the 2 or 3 outliers to get to that return target. So there is, it's not just, I think a lot of people get enamored by venture because it's, you're investing in early stage companies and you're taking a big chunk of risk. For me, I try to take a lot of calculated risks and understanding market, understanding, what the return profile can look like, understanding, all kinds of different factors as we're making those decisions. And I'll just give you one last data point, which is I think this year we'll look at 700 to 800 companies, and we'll invest into 7 or 8. Yeah. So we look at a lot of stuff. And so that's why, maybe to your earlier point, it's hard to raise capital because there's a lot of companies out there that are being started every day. And for us, the bar is really, really high. We try to set the bar really, really high. Yeah.
Yeah. Well, I guess it's the other side of, you being so specialized, you're able to see a more where the risks are lower or where there's a more calculated risk. And it means folks entering into your pipeline, they're not talking to an investor who doesn't understand the market or who, maybe I'm not sure if I said that correctly, but there's the bar can be higher because you're looking at 800 shops in this space. So that's interesting.
We'll go deep. I have one LP that I work with pretty closely. He's a mutual friend of ours, Thomas Otter. Sure. And Thomas, I put him in front of a company the other day, and he starts probing on the product and tech. And I was talking to him this morning. He's like, the entrepreneur said, "I've never met an investor or an investor group that goes this deep to the realm of asking about effective dating in a product."
It's so important in HR.
I can't tell you another investor that knows what effective dating is, but it's something that is certainly important. And I'm lucky to have folks like Thomas that can go deep and provide that assessment because it's important. These are, for many people to be like, what the hell is effective dating, or why does that matter? Well, to your point, in a lot of areas of HR, it's extremely important.
Yeah. And to your point, I've met a lot of shops at Series B or C who are struggling with effective dating, or they didn't have it. So a
lot of public companies that don't do effective dating well, George.
Right. Well, we've taken up some time here, but I'm not going to let you leave, given your position in the market, without getting a few trends from you. So what do you feel are the current trends or the things that you're watching that the community might want to hear about?
Yeah, I mean, we could probably record another hour just on that alone, but I think for me, it's a wide-ranging answer. I think obviously, data has become more important than ever. So how companies are leveraging data, managing data is more important than ever around privacy, security around the world. So, to me, I always try to look at okay, this is great, cool product, cool user experience, but how can that data be leveraged in some form or fashion? Yep. So that's one area that, I think it's important for entrepreneurs to have a story around what's their kind of data strategy, what's their data perspective. Two is I just think a lot of existing markets are ready for disruption. So I'll give you one example, which is learning. We've all tracked the learning market for a very long time. I spent 7 years at Cornerstone, which is the leader in learning management. But I just think there's a whole new paradigm shift in what and how we should be learning. That is something very interesting. And I hate to plug a company here, but one of our investments is a company called Arist that's doing text-based learning.
Yeah.
Super fascinating. And why it's important is because, most people, they complete 15% of the courses that they actually sign up for or register for, where, Arist takes that number from 15% to 90% because of the way the courses are designed, delivering it via text, which is, right front and center. So that's just one example of, I think there's a lot of existing markets that are ready for disruption. And it could be tech, it could be product centric, but across the board, I would say every existing category, whether it's compensation or collaboration, is either ready for disruption or in process of being disrupted. And also the last point, which I don't think gets enough discussion, is around the go-to-market strategy. And most importantly is, we've seen this rise of freemium-based products like Slack, but I think go-to-market is more important than ever. You don't necessarily need the traditional building out of the enterprise sales staff that you used to, although that still is important, but it's different than it was 10, 15 years ago. Yeah. But this whole ability to, is what people call product-led growth. I'm super interested in product-led growth strategies. And really the idea is how do you get customers to use the product and increase that usage over time, expand the usage, give them access via freemium version or free trial version. And we're certainly seeing over the last 5 years, hugely successful, not just HCM or HR tech companies, but companies like Twilio that have net dollar retention in the 150, 160. And that's just proof that their product has that stickiness over time. And so product-led growth is a really interesting area that I've spent a lot of time over the last year really trying to understand better. And it's not necessarily everyone needs to do it and it's a one-size-fits-all, but I think every company needs to have some sort of product-led growth strategy as they are ramping up their sales model.
Yeah. Yeah. I sometime I'd love to pick your brain on the product-led growth thing. I have been dipping into that a little, and I found not only is it's not one size fits all, but there doesn't seem to be just one model for product-led growth. And, it always comes back to knowing your audience, your customer, your buyer. And, but I have been really encouraged with what I've read. And, it's like one of the few things I've listened to on Clubhouse. So it was because I learned something there. But I'm with you on all of those trends. I thought your that deal, the Arist deal, the interesting thing to me was not just the disruption of learning, but how the experience level with text, with SMS, it's it doesn't all have to be. I'm sure they've got some whiz bang backend, AI or machine learning or something feeding the content. But for the user, it's not always about, that feels very retro to me, right? Like SMS, but it's what the user needs, and it's about understanding what the user experience needs to be. It isn't always the next big iteration of the user interface, but it's giving them the right content at the right time. And that's why if they're getting 90% completion rates, that's why it's in the right format as well. So I was really intrigued by that one.
And George, just to highlight on them real quick. I mean, what's fascinating about them is they're 3 entrepreneurs. They developed the product while they were at Babson University, or Babson College in just outside of Boston. And so, this is how they live today, that kind of generation using text. And so, when I look at this of, well, why couldn't Cornerstone do this, or why couldn't someone else? Well, they don't have that perspective that 3 entrepreneurs that are 20 and 21 years old have on the kind of what the future generations want and desire out of their enterprise software products. So That one was just a super unique company, great founders. And what I didn't tell you about them, how I met them, is I actually sent the CEO a message on Twitter. So, we don't sit back all day as VCs waiting for stuff to come to us. I love the kind of the hunt of finding interesting companies and reaching out to the entrepreneurs. And that's one I'm really excited about.
Yeah. Well, that's great. We could keep going, but we're chewing into everybody's time here on Facebook. So thank you so much for being here. I always enjoy catching up with you and getting a glimpse into your world. Let's do this again. Let's not wait so long, and maybe check in on the portfolio a few months from now and see how everything's going.
That'd be awesome.
All right.
I appreciate your time, George, and thanks for covering the announcement today. And I definitely look forward to keeping you abreast of what's happening with the portfolio, and hopefully you'll someday see us on some NASDAQ stage sometime down the road.
Awesome. Yeah. Congrats on the announcement and the fun today. All right. Thanks again.
Thanks, George.
Thanks, everyone. Bye.
All right. Bye.